Again, I was talking about being proactive. We have a panel of experts tonight. I'm going to allow them to introduce themselves in just a minute here. I'm looking at my notes and trying to, I think I covered all my notes already. One of the questions that people ask is, are there actions that I can take to lower my rates in terms of defensible space, materials, ingress and egress, having adequate water supply to fight the fire, having inspections done by the local fire district or fire department. All of those are great things to do. I'm not sure if we know yet whether that translates into lower insurance rates or if that'll be beneficial down the road in terms of paying less money for insurance, but it's certainly going to be beneficial in terms of protecting your property. So there's no downside to it. The same goes for documenting your personal possessions. I think many of us feel like somehow we got good homeowners insurance or renters insurance policy, that we're pretty well protected. There's big dollar figures there, that should take care of everything. My personal agent, Jim Galt, has kind of informed me otherwise. So that's why we're here tonight, to really ask the tough questions now. You know, it's always great at the end of the day to get on 60 Minutes several years after the fire, and you can have your 5 minutes of fame, and you can say, well, maybe the insurance companies didn't pay off right, or somebody else did something wrong. But I think we're better off to try to take whatever actions we can right now to protect ourselves. So that is why we're here. Are you ready? Are you ready to talk, Brad?
I'm ready now.
Okay.
I was supposed to be before Howard and set him up, so I put him on the spot. But my name's Brad Peel. I'm a forest hydrologist. I've worked a lot in watershed protection from wildfires over the years in Colorado. Part of the Forest Health Task Force for 6 years or however long we've done this. One thing Howard failed to mention was this: the Forest Health Task Force is funded by the Greenlands Reserve, which is a nonprofit land trust here in Summit County. Howard's the executive director of that organization. So thank you, Howard, for doing that. We've had a lot of conversations over the years and through this year, and one of the things I wanted to just kind of go through really quickly is that we're talking about, you know, houses burning down because of forest fire. What we saw in that video was a ground fire, right? And that looked relatively controlled. They looked like they knew what they were doing. There's two things about that. One is that there was a number of areas that were crown fire, which means the treetops are all burning. Those fire, if that was a crown fire coming at that house, those firefighters would not be there. They cannot fight a running crown fire. It's just not safe, and they can't do anything really to stop it. So if that's your house and the crown fire comes at it, they're not going to be there to put out the little embers and to stop your wood mulch from burning up to your house, burning your house down. That's one thing. And we've had a lot of talk in the last, and a lot of research, debate, interesting discussions about what our fire risk really is, especially after the mountain pine beetle. And we know that after the trees die, the needles turn red, and at that point there's an increased wildfire risk of those trees burning, because those needles have a much lower moisture content than they would if they were alive. But in most cases in Summit County now, those red needles have fallen off, right? And we think, and we know from some research that says our fire hazard has gone down substantially. Well, there's a couple of things that are happening that increase that. And one is that now we've got grass growing, we've got ground cover growing, and that's an added fuel component. So that helps fires. And we also, I don't think we understand exactly what's going on in the lodgepole pine ecosystem post mountain pine beetle impacts, because we've had last fall, we had the Fern Lake fire up by Rocky Mountain National Rocky Mountain National Park on the east side. Still burning, by the way. The guy from Rocky Mountain National Park, the fire manager there, gave a presentation a few months ago that I listened to, and he said, this is unique. What do we see in Colorado? Would anyone expect a fire burning in beetle-killed lodgepole pine with the needles off above 9,000 feet in December, and the ground cover was snow? So these are unique conditions. We saw that last week again in Rocky Mountain National Park, this time on the west side above Grand Lake. The Big Meadows fire, still burning. It burned the first week in June. up to 11,000 feet in mixed conifer. Actually started out in beetle kill lodgepole, which caught it, really made it a crown fire, and it's still burning. We don't see that often either. We're not that concerned usually about those elevations at that time of the year in these fuel types. And so my conclusion from all that is, don't take anyone's advice for granted that says that it's not going to burn, you have a low risk of burning. It can happen. We had it start in Summit County last year, early, when was it? It was like May or April, up by Keystone. March, okay, in March. And that was looking like a pretty active fire. What was the name of that one, Joel?
Well, I think we called it Gherkin fire because it outburned up the Gherkin property.
So, I think all bets are off right now in terms of fire behavior. We're also seeing much warmer conditions, drier conditions. Things dry out really fast right now. And so my caution is that you know, do what you can, and part of what we're trying to do as an organization is to give you some information just about insurance. There's some situations where you're going to do everything you need to do and your house still might burn down. So the best thing to do is make sure you're insured and you can replace your house. That's one thing to do. So without taking any more of your time on that topic, Howard, do you want to introduce the panel?
So we want to go to the experts right away. Does everybody have one of these sheets that says adequate insurance coverage? They were, when you first came in, you don't have to have it, but it's going to give you a good idea of the questions we intend to discuss tonight and others. So I want to start out with Leslie, and then I'm going to go to Kelly, and then to Jim. I'd like you to spend a few minutes to introduce yourselves and talk a little bit about what your background is in insurance and your knowledge of wildfire issues in particular. So if I could start with you, Leslie, that would be great. You got to talk loud.
I'm Leslie Weeks. I'm with American Family Insurance. I've been with the company and my agency up here for just over 8 years. Seen some interesting climate changes up here in Summit County as we've gone along. Prior to that, I worked corporately with American Family, and I've been really involved with our underwriting department in helping to set our new wildfire guidelines and, you know, talk about different counties, different risks, different ways to underwrite that wildfire risk. Been really active in teaching agents to get out to their customers and talk about coming in, reviewing your policies, making sure that you're covered properly. That's kind of been my soapbox that I've stood on ever since I started with the company, so that's probably a soapbox I'll get on again tonight. But happy to be here, happy to answer any questions you have.
I'm Kelly Campbell. I'm with the Property and Casualty Insurance Association. We're not actually an insurance company. We're a trade association, and we represent a number of insurance companies. And the companies that we represent write approximately 40% of the homeowners insurance here in Colorado. I've actually worked in the property and casualty insurance industry for 15 years. Prior to coming to the trade association, I did work for a company. I actually worked for State Farm. I knew Jim while I was there. And I worked on the claims side, I worked on the underwriting side, and I also worked on the public affairs side. So obviously in the underwriting side, I worked a lot with agents, trying to determine what was the adequate amount of insurance for a home, looking at properties, making sure I worked some more in northern Colorado, but certainly in some of the mountainous areas, and looking at those homes from an underwriting standpoint, had folks mitigated their property. So I've been very involved in the wildfire issues from that standpoint. While I was with the company and also now in my current role, I do a lot with wildfire from an education standpoint, working with a lot of national organizations, working on national programs like Ready, Set, Go, working with organizations like the Institute for Business and Home Safety. They do a lot of research about mitigation techniques. So I've been involved a lot on the education side and consumer awareness side.
So Kelly, you wear one other hat. You're on the governor's
Yes.
wildfire task force, and she's going to hopefully be able to report on some of those activities tonight.
Yes, we can certainly talk about that. I'm one of the members of the task force, along with the Division of Insurance. They're also on the task force as well. So we can talk a little bit just in general about what the task force is doing and their recommendations, which do involve insurance, but also involve some other issues that I think might be of interest to folks.
Good.
I'm Jim Galt. I'm a State Farm agent here in Dillon. Took over for my good friend George Osborne about almost 3 years ago now. And originally from Montana, spent some time in Wyoming as an agent about 32 years ago, and came down to Denver, spent the last 25 years in Denver. In Denver as a agency manager, a recruiter, and trainer of the agents, about 140 or 50 agents in Denver. Got to know Kelly down there. It's nice to meet Leslie. I've seen her name a lot, but haven't ever met her. Thank you, Howard, for putting this together. This is a big deal, obviously, the wildfire, and it's certainly a big deal to State Farm, as you might imagine. State Farm, primarily because of a lot of activity that George and Rob Nelson and a lot of the agents down in Denver in the Front Range have done over the last 30 years nearly, has a very large market share in Summit County. I would venture to guess to say, if I could be a fly on the wall at the executive office in Bloomington, Illinois, they certainly have Summit County circled on a map for a very well, I guess anxiety-ridden type situation, since our market penetration is very large here. Ordinarily, State Farm, which is a big company, as most people know, it insures about 1 in every 4 houses in the country, in North America, and in the state of Colorado, we have a very large market share, so it's getting a lot of attention, and I have to compliment the people in Summit County. Many subdivisions and homeowners associations that have gone to so much time and trouble and money to clear cut a lot of defensible space around their subdivisions, most of it at their own cost and expenses, and in an effort to try to reduce and provide those defensible spaces in the event that the wildfire takes off. Most of it that I've been working with around Breckenridge and some up north toward Kremling and so forth into Grand and Jackson County. But I have been with State Farm 31 years, and all of that either in agency recruiting, agency management, or as an agent, and was fortunate when I talked my friend George into retiring to be able to come into Summit County and take over a portion of his agency, and it's been really a good experience for me, and I've enjoyed it a lot. I am every night thankful when I go to bed that forest fire didn't start here, and I feel really bad about what's going on down on the Front Range, because they've been really struggling down there. I know a lot of my friends that are agents down there have dealt with quite a few of the losses, and I don't know yet what State Farm's portion. You may know what American Families is, I don't know, but I suspect we're going to have some rather high loss ratio as far as that part of the state's concerned. So thank you again for putting this on, and thanks for inviting me over.
So what I've done is I've asked each of the panelists to start out with a couple of starter questions, but what I would like to ask again, Jim didn't want to do it, but really, I see most of the faces this direction. You're looking at me. I really have nothing to say. If I could ask you three to just switch places over here, would everybody feel good about that?
Yeah.
I would like to make a quick announcement, please. I'm Shirley Rose and a member of this group, and I would like to introduce my daughter and son-in-law, Ben and Flo Reitano. They're in the back there.
All right. Good job, Shirley.
Shirley just turned 90 years old. Was it Sunday?
The 15th.
The 15th.
All right, Shirley.
So you guys have your starter questions, and Brad and I are going to help to moderate. These are kind of my novice questions just to kick off the discussion. So I don't know who wants to start on one of those or both of those.
On you're talking
the very bottom.
on the bottom of that introduction, wildfire insurance meeting.
Right.
I can go ahead with that question. Can I insure for more than the appraised value of my home to make certain I have adequate coverage? Again, like I told Howard before, I generally will confer with the State Farm management folks before I ever come to a meeting to see. They don't like loose cannons out in the public necessarily, and so at the risk of any antitrust commingling whatever information with American Family, I would say on behalf of State Farm, a lot of the stuff that I may say, if State Farm doesn't want me to say anything about it, I'll generally say I'll give you an opinion. It may not reflect exactly what State Farm would say, but I would say certainly you can insure your house for really whatever you want. The parameters that we would use is that we have a goal to try to insure for 100% replacement cost on the house. Now, we will accept less than 100%. There's a percentage that we would write down to that would be in the neighborhood of 80 or 85% of 100% replacement. You might ask, well, how do you come up with a 100% replacement? And we do it through a method that involves a computer program that we feed in a lot of information about your house. Practically everything we can get our hands on, and it's a 50 or 100 questions. It's a lot. And we're trying to determine quality of the workmanship and the materials and, of course, square footage of the house and style of the house, and does it have a basement, does it have attached garages, and so forth. And I assume most every company will come up with some sort of a plan to develop 100% replacement cost numbers. Now, what the underwriters will tell me is that if you are willing, or if you can insure for 100% replacement on the house, then we will extend a replacement cost, not necessarily a guarantee, but it's a replacement cost figure to indeed replace the house back to the way it was prior to damage. If you intentionally insure for less than 100%, and as hard as it is to believe, there are people that do that, then we will not guarantee replacement. In fact, if you get below 80% replacement by our numbers, we would go to an actual cash value policy, which would simply be a depreciated policy at the time of loss. In my 31 years, I've not insured anybody under 100%, at least as close to as what we can get 100%. And obviously, as everybody might imagine, that 100% figure may be outdated and it may be inadequate in a month. Certainly up in Summit County with materials and labor and costs and so forth that fluctuate by season, it's possible for a house to be at 100% replacement, and we're doing the best we can to get to that figure, and in 6 months it's outdated. But as long as we've made the attempt, at least that's our philosophy, as long as we've made the attempt to insure it 100%, then we will extend the 100% replacement cost factor onto the house. Now, if you choose to insure it for more than that, and there are people that do, there's nothing that would indicate at the time of loss that you're going to get that. If we insure a house for $1 million and you choose to insure it for $1.5 million, and it costs $900,000 to rebuild it, you will get the $900,000. And so I would say if you wanted to insure it based on an appraisal, which are really two different things in my book anyway, replacement cost versus appraisal value, you may be spending a lot of money in premium for coverage that you may not eventually get if and when the house is lost.
Leslie?
I'll piggyback off of that a little bit. Our company does not allow us to insure for less than 100%, so we make every effort to make sure that you're at 100%. But here's my soapbox. It's really important that you talk to your insurance agent at your insurance company and find out where they stand on that issue so that you know your policy is going to rebuild your house to the way it is. We will allow you to over-insure your house as well. Again, we're going to pay you what it takes to rebuild your home in a loss. And we also have a 20% cushion kind of above and beyond that 100%. So we can hopefully account for some of those fluctuations, especially in a catastrophe that happened, account for those building cost shifts. Other than that, I think Jim did a great job talking about that.
And also, and I think this is not unique to any one company. It's I think part of every company. We generate a premium figure based on what we insure the dwelling for. but you automatically have coverages, normally in the amount of 75% of additional coverage allotted for contents. You have an additional 10% allotted automatically in your policy package for a extension dwelling, which would be detached structures on your property. That's all covered under a percentage of whatever we insure the dwelling for. So if you decide to, if we're insuring at 100%, you're automatically going to have an additional 75 allotted for content. May or may not be enough, but that's what the original package comes with, and then extension coverage or dwelling extension coverage 10%. And so it's important to note too that those contents coverages are set initially based on whatever you insure your dwelling for, and then you've got to basically go from there. So if we were sitting with someone and we determined that a house was to be insured or 100% of replacement was $1 million, they're automatically going to have 75% additional allotted for contents. And my question would be, do you think that's enough? If it isn't, we can add coverage.
So let's follow up a little.
What percentages are generally allowed or built in for debris removal? We haven't talked about that. Your house burns down to the ground, it might cost you $70,000 to clear that lot.
Mm-hmm. It's a percentage also, and I'm trying to think what that is, but it's considered as part, for us anyway, as part of the loss. So we would take into account the cost for debris removal into the total loss figure. We would insure, we would pay up to the amount you have the dwelling insured for, and we too then have a bit of a buffer. We have an additional 20% of additional coverage allotted for coverage to the dwelling, which it could also would carry over for items like debris removal. In some cases, landscaping.
Well, just for sake of argument, a home with 1.4 appraisal, replacement cost is 1.1, allowing 2 for the property itself. You don't insure the property, the ground.
Right.
So you're saying some of that debris removal cost could come out of that 1.1. Yeah, I don't think most people think about that, and that could make a difference on where you want to insure.
That's right.
It does, and when we figure in our replacement calculation, our computer system and everything else, they're figuring you're starting with a vacant piece of land, and you're redigging your foundation, you're doing all that. So that calculation for those things you may not have to do can really offset the debris removal portion of it as well in a rebuild. Many times in a fire, you get to keep your foundation if you rebuild the same time.
And they are finding, and I'm sure you guys have heard that too, these fires that in Fort Collins in the Springs over the last 2 summers have burnt so hot that they have compromised and really destroyed the foundations. And know that we had a memo come out about 3 months ago, and then again about 3 weeks ago, stating that in conversation with policyholders, it's important that you factor in now replacement of that concrete in the foundation, and also factor in delivery of materials. And for some of us up here, just getting the materials to your house site is an added expense that also is borne by the amount of coverage we have on that dwelling.
Yeah, and I just wanted to add, and Jim, I think you hit on a really good point. It is really, really important to make sure you have that dwelling coverage. It's also known as coverage A. You will see that on your deck page. It's really important to get that right because there are so many coverages that are determined based upon that number. And obviously companies have tools that they use. You can also go out, you can speak to contractors if you have some specific concerns about like debris removal, things like that, what experience they may have to help adjust that number and have those conversations with your agent. But there are a couple other coverages that I want to mention too that are critically important. Your additional living expenses coverage. That's how much coverage you have if you're out of your home to rebuild it. There are companies do that coverage different ways. Some companies do it by a period of time, so you would have coverage up to 12 months or 24 months. Some companies do a lump sum, and it's based upon that coverage A again. And so if you have, $100,000 replacement cost on your home, because I need simple math, and you have a 20% additional living expenses, then you have $20,000. So if that takes you 12 months or 24 months, that's the amount of money you have for additional living expenses. So it's really important to understand how your company does that coverage and to make sure that your coverage A is accurate and that you understand what that number is. Another key component is law and ordinance coverage. Again, this is typically an additional coverage on top of your coverage A. Some companies have done it a little bit differently, but there was legislation this year, House Bill 1225, that will make that law and ordinance coverage an additional 10%. Companies have to offer that coverage starting January 1st. So that's certainly something you should talk to your agent about if you're interested in getting that kind of coverage. But again, it's another buffer. It's called law and ordinance coverage.
Yeah, what does
So
it do?
basically,
It's for law. It's for any costs to rebuild your home that are a result of changes in building codes. So fire-resistant materials that may exist, those kinds of things. So it's a really important coverage, particularly in wildfire areas.
and particularly in a partial loss. So if you just have
Absolutely.
smoke damage, that's gonna have you, rebuilding walls or, a portion of your house, they may make you bring the whole house up to code. And it's that additional cost of something there that wasn't there before. So that's definitely important. And, the ordinance or the additional living expenses, it's also important to find out how your company covers that in the event of a mandatory evacuation. How long they're gonna cover you, what type of expenses they're gonna want you to document. I had a situation where a customer paid for everything in cash. They had no way to document what they normally spent on food, and it made it really difficult for the adjuster to figure out what their additional living expenses were. So it's a good idea to have some sort of documentation, of your additional living expenses, so that it just makes that process that much easier for you if something happens.
I wanted to go back to contents for a minute, because it seems like it's a fairly healthy figure, but if you have really nice furniture, it may not be enough. Or if you're like me, you get your furniture from Goodwill or something, it's probably way too much. So can I just, if I have a certain amount for contents, can I just say, okay, replace contents, and you'll just write me a check?
No.
Oh.
And that's a great question. I actually meant to piggyback off of Jim a little bit on that too. Check with your insurance company and find out if certain items are limited on your policy. You may need to schedule specific items on your policy to make sure that you get their replacement value if you have a claim. We recommend that our customers take photos, open cabinet doors, open closet doors, take photos and upload them to some off-site place where you don't have to think about grabbing it if you have to evacuate quickly. It is your job as the policyholder. You have the burden of proof of what you had. And you generally only have a year to come up with what you're missing. Sometimes we use stuff every other year depending on like the ski season or whatever. You don't want to think about it 2 years later and not be able to get that item replaced.
That's probably the biggest question that we get during a review with someone is, do I have to have receipts and do I have to have documentation of what I lost? And I think the short answer to that is yes. Every company probably has a somewhat of a template for home inventory checklists, and you're certainly welcome. If you send me your email address, I'll just send that to you. But you can go on statefarm.com. They have a program. What am I thinking? It's what is it with the little icon? An app. That a lot of people, I think, can access and use that as a good way to start generating an inventory. But the pictures, any kind of gathering of receipts, anything that you can do to show that claims adjuster not only what you had, but the quality of the stuff that you had can help you get that claim settled very, very quickly. I know some of our guys had the biggest trouble. It stretched out for months and months and months trying to gather information on a lot of the losses up in Fort Collins, simply because they had absolutely nothing to show them. And so they're sitting there with a checkbook and saying, I'm ready to write a check. How much did you lose? Show me what you lost. And they had to take forever to try to figure it out. And then, of course, inevitably, you remember 6 months after you got your settlement check that you missed about half of your basement. And that may not be the best time to come back to the claims office and say, I forgot a couple of items.
And I think your point, just anything you can do, anything you can do to document it. If you don't want to use that form, don't use it. If you have a flip phone, just do a video, take 10 minutes. You know, with the clouds and everything else, it's a lot easier to store that. And everyone you talk to who has lost their home in the claims process, they said the most difficult part is remembering all the things they lost. So anything you can do to help yourself will go a long way if you are in the unfortunate situation of losing your home. It's something that can be done very quickly, very easily. It can be done very informally. I mean, claims adjusters accept almost any kind of documentation. They just want to have some kind of sense of what you had, what the quality was, and just so they can adjust. So anything you can do.
We had, oh, I'm sorry, go ahead, Lisa.
I was just gonna say, the short answer to your question is no, they're not gonna cut you a check for 75% of your dwelling value. You shouldn't expect that. You're gonna have to produce something. And I think pictures are so easy and inexpensive these days. I just think that's the best way to go. But.
How about if it's jewelry or something, or a painting that has some value, should you get it appraised?
Talk to your agent. I would assume every company has similar but slightly different internal limits in their policy for certain items. For instance, our basic policy has a $1,500 limit for jewelry. If you have a piece of jewelry more than $1,500, it's a really good idea to talk to your agent, find out if you want to produce a appraisal and schedule that on your policy.
Is that per item or total?
The 1,500?
Yeah.
That's per item. It's a $2,500 total limit.
It's important to differentiate, and those numbers are not very far apart no matter how.
They're not very far apart, and they're not very much.
Back there, I found these items online that we're dealing with emergency evacuation checklist. I only brought along a few, but what to do before leaving, what to do or what to take, and that sort of thing. And it's kind of a good checklist just to go through it to make sure that you kind of accounted for a lot of different things that all of a sudden when you're told to get out of your house, you don't have time to sit and think about. And it's sometimes good to have a checklist or something that you can kind of get ahead of the game and put that stuff together. And again, I think all of the insurance companies would tell you that the inventory is very, very important if you expect to get compensated for your loss fully, and to make sure that you're prepared in the short time that you're given to evacuate and move out of the house, what you need to take, and maybe have it all in one spot. And I guess I assume a lot of people do that automatically, but I'm sure that's probably not always the case.
So where you have important documents, there's always safe deposit boxes, but is it important also to have information in the proverbial cloud or other places where it won't be damaged by the fire?
I think a good point, you know, like at First Bank, it's great, the vault's fireproof and everything, but if they don't get that vault door closed properly and they have to evacuate, all the safety deposit boxes are plastic from my understanding. So I absolutely think it's important. Now that we have the type of resources to upload our important documents and put them somewhere out there where you can get them from anywhere, I think that's very important.
You know, one thing I wanted to mention about the claims process that I think is confusing to folks, and I think it's important to know, just to understand about your insurance, is if you are in a situation where you do have a total loss and you're looking at replacing your home, just very generically how the claims process works, you know, both Jim and Leslie talked about the fact that the amount of settlement you will get is based upon how much it actually costs to replace your home. So even if you have insurance for $1 million, if it costs $900,000, that's how much you're going to get. But it's also important to understand that you get the replacement cost coverage at the time you replace the item or the home. So typically how the claims process works is up front or at the beginning of the process, you get the depreciated value, which I think you both mentioned, for the property. So that's kind of the upfront money, and then as you determine what the replacement cost is and you replace those items, then you get the additional dollars. So if the depreciated value is $100 and the replacement cost is $200, you would get the $100 up front as kind of the actual cash value, the value of the item that you lost, and then you get the additional dollars upon the replacement. So it's kind of two different steps in the claims process, and I think when people know that up front, it's helpful.
Could you have a cash flow problem then, if you hire a contractor and the additional money hasn't come through yet from the insurance company?
You know, typically contractors are pretty good at working with that. I mean, they understand that that's how the claims process works, and so that, you know, they typically have estimates, and that's usually part of the building process, is you don't give all the money up front anyway as part of that. So, you know, typically that's kind of understood through the construction process. But it is important to know, because I think sometimes people expect to have all that money up front, and so it's just important to know that that's not how the claims process works. So when you are talking to your contractor, that there's the same understanding by all parties.
Just as an option, what if you choose not to rebuild and just move somewhere else?
I think that every company probably handles that a little bit differently. I can speak roughly from American Family that there are a lot of people in the Hyde Park fire, for instance, that didn't want to live in those canyons anymore. They just didn't want the risk anymore, and they chose to purchase already built homes in Fort Collins. That's okay. Like kind quality up to that limit, they were paying. Sometimes that was the depreciated value, sometimes that was closer to the replacement value of their home, but they were able to relocate. You can choose not to build with American Family. You can choose, let's say you have 2 homes and you decide just to move into your other home in California. You can do that, but we're only going to pay you the actual cash value or depreciated value of your home.
You've obviously, or many people have, I shouldn't say everybody, but many people have a mortgage on that house, and that mortgagee is also of interest to the insurance company, because for the most part, there are additional insureds on the policy. So they have to be worked with as well. And, you know, I think you're right, Bob. A lot of people certainly may choose not to rebuild in that location for whatever reason. And every insurance company, I think, is going to do somewhat similar settlement options, and they'll work through that with you and the mortgage company. And I have people that ask me that same thing, and take it a step further and say, but I don't want to build exactly the same kind of house. Would that be all right if I do it? And yeah, I mean, you can do that. Contractually, our agreement with you is to rebuild your house to the way it was prior to the loss. If you want to alter that, then you're going to have to understand there's got to be some alterations made possibly in how much they're going to pay you for it. And Leslie and Kelly are correct that depreciated value at the time of loss is probably the most misunderstood segment of the settlement process. Is that, what do you mean you're only going to give me a certain amount of the money? It would be very similar, and we used to go through this 2 or 3 times a summer, it seemed like, in Denver, on hail losses. They're not going to come in and pay you 100% of the replacement cost on that roof until it's 100% repaired. They'll pay you the depreciated option or the depreciated amount on it. When you present us the final bill that the roof has been replaced, then we'll finalize that payment of the replacement of the roof. And the same thing could be said for the complete reconstruction on the house.
So if you're going to rebuild or something like that, you'll receive a certain amount up front, which will be less than the full insured value, and then the balance upon completion.
And well, I think that it will probably flow. I mean, you had mentioned with the contractors know who's paying their bills now. And so I think the adjusters, and I know State Farms do, work closely with those contractors because they have to get along. And I think the payouts will come as the cost is incurred. I mean, I don't think anybody's going to expect a contractor to extend costs or credit to a homeowner while they're in the course of building their house. And by the same token, the insurance company is not going to expect the homeowner to go take another loan out to cover that cost until we can pay you off at the end. They'll work as the house is completed on the payments.
Yeah, there's multiple payments that happen in a claim.
Okay.
Yeah, I mean, if you're going through the rebuilding process, so you are replacing it, It's just, oftentimes that becomes a point of contention, sometimes early in the claims process, that people just don't understand that you get that money up front, and then more money is going to come, but it just doesn't all happen at one time.
And, yeah, we just want you to understand the insurance company isn't trying to short you money.
Yeah.
It's just how the process is designed to work.
Any question over here? Over here. Go ahead.
Yeah, are any of your companies now withdrawing and no longer insuring some houses, dropping houses?
Do you want me to go ahead and jump in that from an industry? We
From
have to
an
be,
industry
we have,
standpoint.
yeah, we have to be really careful, just so folks understand, we have to be really careful from an antitrust standpoint that we don't talk about individual company practices, particularly in regards to pricing or market conditions or things like that. So there are some questions that are really better to be addressed from an industry standpoint than an individual company standpoint. So I just so that people understand, no one's hiding the ball. Just legally, we have to be really, really careful about that. But you know, to your question, you know, insurance companies have to manage risk. That's what they help customers do, is manage risk. And so companies are going to look at an area, and if an area is too risky, then they may choose to not write as much business in that area. And we are seeing some of that take place. We're seeing some shifting take place in Colorado, but what is interesting, we're also seeing some other companies that are set up a little bit differently that are wanting to come in, and that's more of what their type of business is geared towards. And so there is some shifting going on. There's definitely, we're seeing some companies that are non-renewing policyholders, but we're also seeing that those policyholders can get business or get insurance other places.
What notification is generally given if they're not gonna renew you?
It's typically 60 days. Law requires 30 days. So, you know, most companies give a little bit more time than that, so you will have time to shop around.
One other exclusion that I heard about was that if homes have a considerable amount of time that they've been vacant, for instance, if I have 2 homes and I spend 6 months here and 6 months there, my insurance may be in jeopardy because I have so much empty time in my Colorado home.
You know, that's a general that's a general risk assessment that a lot of companies within the industry do. So that's a key factor, regardless of whether or not you're in an urban area, a wildfire area, anything, is vacancy. Because obviously, if no one's looking after the property, it's a higher risk. So that is something that companies look at.
It is in the policy. I would encourage you to talk to your insurance agent about that, because it really determines, the company will determine what they consider vacant. And many times a fully furnished second home is not considered vacant even if you're not there right now. So
You're charged
talk
more.
to your agent.
If it's a seasonal or a secondary home, it's a different rate. But if it's just flat vacant, you know, somebody has
Totally
just
empty.
left.
Okay, but I think you're hinting that if the house is being rented for part of the time, there may be a different circumstance.
Oh, yeah.
And that
Yeah, I
should,
mean,
so that should be in your policy when you subscribe.
Yeah, now vacant versus rented, very, very different
I realize it's
circumstances.
very different, that's why I
Yeah.
separated them.
Yeah, a homeowner's policy traditionally, unless there's a special endorsement on it, is not gonna cover you for short-term rental usage. If you start short-term renting your house, you wanna talk to your agent, because you probably have the wrong policy and you could be declined for coverage.
Question over here.
Yeah, I'd like to follow up on the availability insurance issue. You talked about, you know, insurance companies are doing risk analysis. Here in Summit County, we haven't had a major fire in 50 years. We've done substantial efforts in terms of fire-wise, defensible space, cutting clear cuts for defensible space again. And we haven't had a recent fire history. We have a very different climate than other parts of the state. And yet, we're seeing our insurance rates going up substantially. We're seeing companies pull out of the marketplace. I know you guys are kind of on the front lines, and you don't have control over what your offices are allowing you to write and not. But my question is, what can we as consumers, and what can our government officials, some of which are here in this room, do to convince these insurance companies that we aren't a higher risk, if anything, we're, you know, in the islands where I live, we have Pakistan trees that we did 10 years ago. We have less risk. What can we do to convince the head offices to write policies here and write policies at rates that they wrote before, where they had very good histories in terms of their returns?
You know, Colorado, from a big picture standpoint, is a very difficult state to do homeowners insurance business in. It's one of the top 10 in the country for catastrophes. So I know we don't think about that. We think of the East Coast and hurricanes, but actually Colorado beats out a lot of those East Coast states. So there are a lot of catastrophes and a lot of different dynamics that are coming into play to what we're seeing now that is resulting in the cost increase and resulting in some of the non-renewal type activity that we're seeing. So it's very multifaceted. To try and put some numbers behind that, last year alone, insurance companies paid out $1.20 on average for every dollar that they brought in. To compare that to the national average, insurance companies paid out 70 cents on every dollar they brought in.
But they didn't do that in Summit County.
So
if we call ourselves, if we seceded and call ourselves West Colorado,
yeah.
is that what we need to do? You know, it's a big state, and it's a lot of different geographies and a lot of different risks, and we don't have the same risks that they have in the rest of the state.
It is, you know, and I mean, in insurance companies, it's a balance. I mean, you try and pool similar risks, but the point of insurance is to pool risks. So there is always going to be within that pool, not necessarily perfect, you know, one-on-one comparisons of risk. So there is going to be some subsidization that naturally occurs. That's part of the purpose of insurance is to pool that risk. And so, you know, that is a little bit of what you're seeing as well. And Colorado has had those numbers that I mentioned. We've had those numbers year over year over year. And actually, when you go back to 07, 09, we had some years that were even worse than that. You're talking $1.40 for every dollar you're bringing in. So, you know, it may not be right here in Summit County, but again, when we look at insurance and we look at pooling that risk, we may be looking a little bit broader than Summit County and some of these other areas that have had some risks. And the reality is you may be paying less, or you may have insurance more available here than they do, you know, down the road, one direction or the other. So again, I encourage folks to really, you know, if you're not sure, shop around, find out what's out there on the market. Because the good news is, in Colorado, although we are a very catastrophe prone state, we do have a very good regulatory system. And so what that means from an insurance standpoint is companies, despite all these other factors, want to do business here. So we are seeing companies that, despite the fact that we have a lot of catastrophes, they know this is a good place to do business. And so we are seeing companies wanting to come to Colorado and do business. So I encourage people to shop around.
I think what we're going to see. Quick comment, and then we've got some more questions. But you know, I understand what you're saying. So you are exactly right that we've done a lot in this county in terms of mitigating our fire hazard. And we do live really high. We do have slightly different weather. But it does seem like the weather is changing, and we've got some scientific proof that it's changing, both in terms of some analysis CSU's done, which is one reason why the Mount Pine Beetle epidemic was so extensive, which it wasn't in the 70s, right? And so, I mean, we can talk about this for a long time, but I think, I'm not sure that we are. I'm not sure that's a correct statement that we are at less risk in Summit County than other places. I mean, down in the Front Range of the Ponderosa Pine Zone, yeah, they get much higher hazard. You know, there's a higher risk there. But I'm not sure that it's different here than Aspen or.
But we're certainly much less than we're in the Front Range where all these fires have been going on.
They have a higher risk, but we might have a higher hazard, which means that if it happens here, it could be catastrophic. So yes, the question.
You know, you've been talking about basically what is relevant to single-family dwellings. But we have a lot of condominiums here. So how does that picture change if you own a unit in a condominium?
I would highly recommend you to talk to the agent that insures the HOA. Find out where that policy starts and stops, and make sure that you carry a contents policy that fills those gaps. Many companies, condo insurance is one of those things that it can be different per association, it can be different per company. company on how those work, so you kind of need to talk to the agent on both sides and find out where your gaps are and make sure that you're covered appropriately. At a condo unit owner's policy, the HO6 policy, you can design that to really fully cover yourself against loss assessment, any structure that you're required to cover, any personal property that you have in there. If you use it as a rental property, there are policies that can cover you the same way as an HO6, only for rental usage. So, but I would talk to the agent on both sides.
And that's absolutely right. The condo association policy can vary. Most of the ones that I have seen are really pretty much Cadillac type policies, where they not only extend coverage from the studs out, which would primarily be the exteriors of the buildings that house the units, but they will also extend inside the units and provide coverage for even betterment and reconstruction on the building property, such as the countertops, cabinets, flooring, walls, wall coverings. And the HO6s that we would sell to a unit owner or a rental unit for condo rentals are primarily important for, as Leslie said, the contents that you house in there, because that's not going to fall under the HOA coverage, and your liability protection. If you had mentioned that the risk in Summit County isn't nearly as great, but the risk up here for water damage that has taken place over the last 6 years is unprecedented in the country. We've paid a lot of losses on stuff like that that generated a lot of cost and expense toward the insurance carriers, and in the condo units especially. If you've got a unit that, for example, has an overflow of a toilet or even a burst pipe for some reason, and floods not only your unit but 10 others, you could be held responsible or liable for that, and that liability coverage that you carry on that unit owner's policy or the rental unit owner's policy it could be called into play in a situation like that if you were considered to be negligent in the loss of your neighbors around you. So the homeowners association master policy, for the most part, is going to provide coverage for the structure, and in most cases interior and exterior. I say most because not all. And then the unit owner's policy in addition, and I think there's a lot of overlap on some of those policies where you're really double covering some of the interior structural parts. But primarily for the contents and liability and loss of use of the unit would be a big deal for the condo unit owners.
I just want to follow that real quick with, I run a lot of condo business in this county, and I've seen a big shift of HOA boards purposely changing their decks and bylaws so that you as the unit owner take on more of that interior risk of your unit. So those Cadillac policies are starting to trickle out a little bit. And so I highly recommend you read your most recent decks and bylaws, talk to the insurance agents on both sides, and make sure that you're not responsible for the interior. My understanding of the Colorado laws is that if you're an HOA and you're responsible to insure the building, you can insure no less than up to the unfinished surface of the drywall, but you may not be required to insure the inside as an HOA.
Sticking with the condo questions, is there any advantage to having your HO6 policy, your unit policy, with the same company that carries the HOA building insurance, so that the same company would be talking to itself on a claim? Or is it better to carry insurance with separate companies so that, I don't know, maybe it would increase your odds of getting good coverage?
I would just, there could be an advantage to going with the same company because their policies may work together, but frankly, I think the bigger advantage is making sure that your personal insurance is with someone that you trust, that you have a good relationship with, and that you can have these kinds of conversations with, because a lot of those policies, as Leslie said, can be made to fit with your master policy. So that's a gap that can be covered, but what you can't make up for is that relationship with a company, with an agent, and that's really important to make sure that you have the appropriate coverage, whether it be homeowners or other lines of insurance as well. So, you know, that's an important piece. You know, you want to make sure you have the right coverage, but there's a lot of ways to get at that.
The master policies, and Leslie is right, have become somewhat susceptible to alteration because it seems like every year the board of directors or the board on that homeowners association wants to bid the coverage out on the master policy. And she's absolutely right. It appears that they're moving away from expense to the homeowners association and trying to shift that a little bit more to the unit owners. So you'll see condo associations that are opting to carry high deductibles, 10,000 and more, that sometimes put the homeowner in a difficult position, because even if the master policy agrees to take care of betterment and improvements of the interior of their unit, they may assess that homeowner the deductible, and they may assess them, all of the unit owners, a loss assessment, which is also a part of your HO6, which is good to know what you have and how much you have. But I would say that the most important thing, rather than even having it with the same company, because I really don't see a huge advantage to doing that. Most all of the companies will work together and pay what they owe. But is to have a very good understanding of what the bylaws of that homeowners association say, because I've run into a couple of situations where the unit owner thought the master policy would cover damage to their structure, and the bylaws did not say that. And that's not a good time to be arguing that point when you've got a interior of your structure that's destroyed or damaged, and you don't know who's going to pay for it, because the insurance companies aren't going to rush in and jump to it unless they know whether or not they're ultimately going to be responsible for it. And so the bylaws, I think, like Doc on the bylaws up in Breckenridge, I think that's something that unit owners need to go over every year, and they may, I don't know. But I've run into a couple of situations, and I bet you have too, where they're not sure. They think that the master policy is going to provide the protection, and they find out later on that they went to a more skeleton policy on the master, shifted a lot of that to the homeowner, and the homeowner didn't update his HO6.
Just one more point when it comes to different companies. I absolutely agree that the relationship that you have with your agent is absolutely key to understanding that. And if you have two different companies, they may, you know, the HOA's policy may require the homeowner's policy to decline the claim before they'll cover it or something like that. So there may be a small delay, but it's not the end of the world when it comes to coverage, whether they're with the same company or not.
Question over here? Go ahead, sir.
A couple of questions tied into one. Goes to a similar thing, but I don't know if you can speak to it. If there have been certain areas now that have been declined because of the recent fires on the Front Range, where insurance companies are pulling out of Summit County or declining them, and does it matter if the area has paved roads, accessible roads, fire hydrants every 500 feet or whatever? And the third thing would be, in the event we're starting to see companies pull out and uninsured, do you see Colorado going into a similar vein that Florida went in when they were forced to do shared insurance because of a lack of insurers wanting to insure in the state? Is Colorado heading in that direction, or are we there?
To jump in on
Yeah.
that? Okay. So let me talk a little bit about kind of the risk management process, or the underwriting or the non-renewal process that you referred to. You know, essentially how that works. Now a company may look at a specific area. They may look at Summit County and say, hey, we need to look at our risk here. But the law requires companies to look at individual risks. They can't just say, we're completely getting rid of everything here. They do have to look at individual risks. They have to file their underwriting guidelines with the division, and they have to consistently apply those underwriting guidelines. Those are the kinds of requirements that companies have. Now, that being said, there are some underwriting guidelines that companies could have that may make a neighborhood, for example, ineligible for coverage with them. You hit on a key one, access roads. That could be an important part of how a company looks at risk, is an access road, for example. There could be other things, whether or not it's supported by a fire district or, any of those kinds of factors. Those could be part of the underwriting process that an insurance company looks at. So I don't know if that helps kind of at least, how the re-underwriting process works and renewals in geographic areas. Does that at least address that part of the question?
The question is, just in light of the last couple of weeks, is there talk of enough substantial insurers pulling out of Colorado where Colorado may have to look at a similar scenario that they looked at in Florida?
Right, that was kind of question number 2, so I was going to, but I wanted to make sure I at least kind of answered the first part of the question. The second part of the question is, are we heading towards Florida or are we close to Florida? The accurate and quick answer is no. We have a very competitive market in Colorado. So if there are companies leaving, and again, that's something we all can't talk about legally, but if there are companies that are leaving, we're also seeing companies that are coming in because people can find insurance. So it may be a little bit more expensive. There may be some other things, but it is available. And as far as are we headed towards Florida, and Howard, I'll kind of leave this up to you. These are some of the things that we've talked about in the task force. So if
would you like to segue into that right now?
Or if you want to dive in, I'm happy to do that.
Why don't you segue just a little bit right now?
Sure. So the governor's task force has been meeting. We were appointed in January. We began meetings in April. And the first couple of meetings were closed meetings, and that was really because they were organizational meetings. We were trying to understand who all was at the table. This was a very unique task force. It has people from all different walks. It's got the Forest Service, it's got the mortgage lenders, it's got the insurance companies. So it has a whole lot of different interests at the table, which is really what the governor wanted. The governor really wanted kind of all the different perspectives that are involved in this to sit around and talk about this issue, because we all talk in our silos. But we don't break down those silos very often. And so that was really the first couple meetings, getting to understand who all was at the table, what our area of expertise is, and learn a little bit about all these different groups. And then we began to kind of pull together recommendations. They were kind of general draft recommendations. Here's kind of what we thought. Based upon the information that we've heard, what do you think might work based upon your experience? And so, because we had to start somewhere. So we had to get some ideas on the table. And so we threw out pages and pages of those, and we responded and went back and forth. And then, it really ranged. I was telling these guys, one of the early recommendations was to require people to meet with their agent every 5 years to talk about their insurance coverage. I'm like, woohoo, yeah, let's do it. If we could figure out how to get people to do that, we would have shot that magic bullet a long time ago. So there are things like that are really good ideas that we want people to do, but they don't really translate into any kind of regulation or public policy. So, there were things like that were good discussion points. And so from that, we've really whittled it down, and we're really starting to kind of hone in on some recommendations. Now, none of these are final. They're still very much in draft form. They're still conversation, and they're just kind of skeletons, so we don't have a lot of meat on the bone yet. Kind of what the time frame is, and then I'll get into generally what some of those recommendations are. Originally, we were supposed to have recommendations to the governor by July 1st, and we just haven't been able to get it all together that fast. It's just been taking a lot more time than we thought. So we are going to get an interim report to the governor, so that should be available. That will be publicly available, and I'm happy to share it with you. It should be available at the end of the month, so I'd be happy to get that to you, Howard. And so that we're giving him a progress report, and then our hope is really 60 days after that to have our finalized recommendations, no more than 90 days after that. But I think we'd really like to get it all done before Labor Day. So that's the time frame we're working under. Now, some of the broad ideas that we have talked about is, I'm going to throw this one out first because I know folks aren't going to like it, but just so you know what's being talked about, there is some conversation about a per parcel assessment for homes in certain areas for fire activities, fire suppression, fire education, firefighting, a lot of those activities. It's based upon a law that was passed in California in 2012, or 2011, effective 2012. So the funds are coming in for this current budget year. So that's what it's based on. The California fee is $150 per parcel. So that's the California fee. We haven't talked numbers, we haven't talked any of that. But that's just how it's structured in California, just to give you some idea. In California, they already have areas identified through mapping that are subject to this fee. We don't have that yet in Colorado, so that would obviously be a part of it. And so that's another element of the recommendations, is creating some mapping programs to better identify some of these different geographic areas. So that may go to some of the issues that you raised, and some of the different elements that are in different geographic areas. And so this could come into play with the assessment. It could also come into play with disclosures on property and selling property, saying, hey, this home has been identified as being in the WUI, or being in a high-risk wildfire area, or being in a medium-risk wildfire area, or whatever. Again, no meat on these bones, but just very generally some kind of disclosure in the purchase and sale of a property that it has some wildfire risk around it. One of the other elements then is how does this play into insurance? There was some conversation in the early recommendations about creating some kind of state-sponsored insurance program similar to Florida, also similar to kind of the wind beach plans that exist in Texas. It's also known as TWIA. We've done a lot of looking into that, and at this point I don't think that is a place that the task force is going to go, for a couple of reasons. First of all, we have a competitive insurance market, and we don't want the state to take over the business of insurance. And quite frankly, we've seen from a lot of other states that they're not terribly good at the business of insurance. So that's not where their area of expertise is. And so we've seen situations like Texas, where their wind pool, so basically it's a policy that just covers wind and hail, but it's very underfunded, and it's a constant battle every year. Where do they find the money? And so the only way they can find the money is to have more and more assessments on the people in Texas to help fund that. In Florida, they're now facing situations of how do they defund or depopulate, the fund there. Citizens just simply can no longer hold the risk and the exposure that it has, so they're trying to find ways to get rid of that risk that currently exists in citizens, and trying to now bring private insurers back to the market. So we don't want to create a situation in Colorado where we're seeing private insurers leave in lieu of opting for some kind of state program that may have artificially suppressed rates, which is what you typically see in those areas, because they can't, it's kind of adverse selection. You have the highest risk people coming into one pool, and so it'd be really, really expensive, but you can't charge people to really, really high rates, so they're artificially suppressed, and then there's not enough money when there's a loss. That's kind of the bad cycle that those get into, and we've seen it repeated over and over. So at this point, I don't think that that's a direction that the task force wants to go, but obviously insurance is a key component in this. And so there's other things that we've talked about as far as tax incentives, mitigation programs, how insurers may be able to be involved in that, how we may be able to beef up some of the current mitigation programs that we have. I will tell you, one of the stumbling blocks that we are having as a task force is, and you guys are going to know this issue better than anyone, how do we deal with these situations where we have federal land bumping up to private land? That's the big, that's kind of the big elephant in the room that we're struggling with, how to deal with that, and how does that, and particularly with watershed issues, how do we deal with that? So that's one thing that we are still really grappling with, trying to come up with a recommendation around. So from a very high level, those are the kinds of things we're talking about. But if you have recommendations, these are open meetings. There's a website, and I'd be more than happy to give you that website.
Could you do it right now? Do you have it with you?
You know, it's one of those very nonsensical ones with lots of backsplashes, or that, you know, that doesn't make any sense. The state put it together, we can't help it.
So maybe if you get that information to me, we can put it on our website.
I can certainly get you the link, and you can post that. But it does have our meeting notices. You can see the different drafts of recommendations and responses that have gone back and forth, so hopefully you can kind of see, hopefully those will reflect some of the conversations that we had. But, you know, we're looking for good ideas. If you have some ideas or insights, you know, we're very open to that. We really want to try and find maybe some unique ways to address these things. It's very unique bringing a task force force like this together, so you really do want to have some good substantive recommendations coming out of this group.
So let's take one more question, and then Bonnie Guthrie has a quick announcement, and then we're going to let the three panelists sum up, since we're getting close to the end of the question.
My question is with regard to defensible space. Whose rules prevail, the fire district, the county, or the bylaws of the subdivision?
From an insurance standpoint,
Well, I mean, I want to be able to have my insurance cover me, and if there's a fire, I want the definition of what the defensible space is. When I built my home, we had tree huggers really dealing things, and now these trees are right up against my house. That's no defensible space.
Sure.
So what am I supposed to do?
You know, I think each company has its own rules with defensible space. If you don't have defensible space and we already have an active policy for you, it's not that we're not going to pay your loss.
Yeah, but
yeah,
I want to just be up to date with
But I would, again, the county has, I've found, we just started building a garage, a detached garage at my house. And we found out when we filed our permit that the county's gonna make us cut down actually more trees than what American Family would require. So the county is a great resource for that. The Firewise, I left some Firewise brochures back there about talking about defensible space around your home. You know, your insurance agent, we have some pretty strict rules that we could give you about defensible space. I would assume Howard's a great resource for that as well.
So I think it's important to start with the fire district, because they do inspections for free, and they're the experts in this whole subject. I think the advice that they're going to give us is going to be good advice, and I would hope that the insurance companies would look to that, if you will, certification or improvements made at the request of the fire department, not only in defensible space, but also in terms of change out of materials. There's a lot we haven't talked about tonight. You know, back in the day, and Henry remembers this, wood siding was a requirement of Willowbrook, still is. Is that appropriate anymore for a homeowners association, or should we have other materials that look good but are more fire retardant? So a lot of open questions there.
And you know, one thing I would mention with that and the governor's task force, we've grappled with that question a little bit too, because we do think there's a lot of confusion for homeowners of, okay, I want to do defensible space, but I don't even understand what that means for me. So we have their attention, we have them interested, but then they don't know what to do. But one of the challenges we also are facing is that Colorado is very big on local control, and whether it be the homeowners association, the town, the county, they don't want to give up that local control. And so there's been conversations about, can we do statewide building codes? I don't know that we can under Colorado law. Is that something we should try and do? Is that a good thing? Do we want to have guidelines? You know, what can we and can't we do to help guide that part of the conversation?
I don't think you answered the basic question that this lady has asked, and that is, when you've got the fire district and the county and the insurance company and all these players, how do you negotiate the disagreements and the battles among those, and who's taken the lead, and how do you resolve it?
I would say it probably depends